Before we begin, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only and should not be considered financial or legal advice. The world of insurance is complex and state-specific. Always consult with a qualified, licensed professional before making any decisions about your insurance coverage. You're driving home from work. It's a Tuesday. You're stopped at a red light thinking about dinner when bam, a car taps you from behind. It's a classic fender bender. No one's hurt, thank God. You both pull over, exchange information, and you feel that small sense of relief. This is why I pay for insurance. You file the claim feeling confident. Few days later you get a call. It's your insurance company, and they tell you the three words that every driver dreads. You're not covered. Suddenly, that minor accident is a $4,000 repair bill that's coming directly out of your bank account. How is this possible? You've paid your premium on time every single month for years. The answer is buried somewhere in the 40 pages of dense, legal jargon that is your car insurance policy. And let's be brutally honest. That policy is a contract that was not written for you. It was written by an army of lawyers to protect the insurance company. It's a legal labyrinth, filled with exclusions, conditions, and definitions intentionally designed to be confusing. Every single ambiguity, every confusing clause, is a potential trap. It's a financial landmine that you don't know you've stepped on until it's too late. Millions of Americans are driving right now, believing they're fully protected, when in reality their coverage is a house of cards, ready to collapse with one single incident. They are one unlucky day away from financial disaster, all because they never truly understood the document they pay hundreds, or even thousands of dollars for every single year. This is going to change starting right now. In this series, we are going to pull back the curtain on the entire U.S. auto insurance industry. We are going to demystify every single line of that policy. We will translate the legalese into plain, simple English. By the end of this journey, you won't just have insurance. You will master it. You will know exactly what you're paying for, you'll understand precisely what you're covered for, and you will have the knowledge to spot the traps and loopholes before they ever become a problem. You will be able to confidently shop for a policy that truly protects you and your family, without overpaying for things you don't need. You will be in control. So where do we start? We start with the single most important page of your entire policy. It's the first page you see, and it's the one page that gives you a complete overview of everything. It's called the declarations page, or as I like to call it, the cheat sheet. Go ahead, pause this video and pull up your current policy, either the paper copy or the PDF online. Find that first page. It might be called the declarations page, policy declarations, or just declarations. This is your roadmap. If your full policy is a dense novel, the declarations page is the table of contents and the summary all in one. Getting comfortable with this one page is the first giant leap toward becoming an empowered consumer. Let's break it down section by section. At the very top, you'll see your policy number. This seems obvious, but think of this number as the Social Security number for your insurance. It's the unique identifier for your specific contract. Anytime you call your agent or the claims department, this is the first thing they'll ask for. Keep it handy. Store a picture of it on your phone. Next, you'll see the policy period. This is the time frame your contract is active, typically 6 or 12 months. It will have an effective date, the day your coverage begins, and an expiration date, the day it ends. This is critical. An accident that happens 1 minute after midnight on your expiration date is not covered. Insurance companies are not flexible on this. They live and die by these dates. Now for a section that trips up a lot of people. The named insured. This is the person or people who own the policy. This is you and maybe your spouse. But what about your teenager who just started driving? They might be listed as a driver on the policy, but they may not be a named insured. This distinction is incredibly important and has huge legal and financial implications that we will dissect in a later part of this series. For now, just know who is listed here. It's the foundation of who the policy is built to protect. Below that, you'll find the listed vehicles. It will have the year, make, model, and most importantly, the VIN, the vehicle identification number. You need to verify that this VIN is 100% correct. A single incorrect digit could, in a worst-case scenario, lead to a denied claim, as the insurance company could argue the vehicle involved in the accident wasn't the vehicle listed on the policy. Check it. Now we get to the heart of the declarations page. The coverages, limits, and premiums. This looks like a menu at a restaurant. On the left side, you have the different types of coverage, the dishes you can order. Things like bodily injury liability, property damage liability, collision, comprehensive, uninsured motorist, and so on. Each of these is a different type of protection. They are not the same, and you are not legally required to have all of them depending on your state and whether you have a car loan. Next to each coverage, you'll see the limits. This is the maximum amount of money the insurance company will pay out for a claim under that specific coverage. You might see something like 50/100/25. This isn't a random code. It's the precise dollar limit in thousands of your protection. Understanding these numbers is the key to knowing if you're truly protected or dangerously underinsured. And finally, on the right side of the menu, you see the price for each item. The premium. Your total policy premium is simply the sum of the costs for all the individual coverages you've selected. This section shows you exactly what you're paying for. You can see if 60% of your bill is for your liability coverage, or if that expensive comprehensive coverage on your 15-year-old car is the reason your bill is so high. The last key pieces of the puzzle on your declarations page are your deductibles. A deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. You'll typically see deductibles for collision and comprehensive coverage. You might have a $500 deductible or a $1,000 deductible. Here's the golden rule to remember. There is an inverse relationship between your deductible and your premium. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is taking on more risk, so they charge you a higher premium. It's a trade-off. Pay less now with your premium, but be prepared to pay more out of pocket if you have an accident. Or pay more now with your premium and have a smaller, more manageable bill after an accident. There is no single right answer. It's about your personal financial situation and your tolerance for risk. And that's it. That's the cheat sheet. The policy number, the policy period, the named insured, the vehicles, and the menu of coverages, limits, premiums, and deductibles. This single page tells you almost everything you need to know about your contract at a glance. It is your command center. But what do all of those coverages actually mean? What is bodily injury liability? And why do the numbers 50/100/25 represent the line between financial security and total bankruptcy for most American families? That is the single most important part of your entire policy, and it's exactly what we are breaking down next. Liability coverage is, in the simplest terms, insurance for the other guy. It's the part of your policy that pays for the damage you cause to other people and their property when an accident is your fault. Let me say that again because it is the single most misunderstood part of car insurance. Liability coverage does not pay for your injuries. It does not pay to fix your car. It pays for everyone else. It is a financial shield that stands between you and a lawsuit that could drain your bank account, seize your assets, and garnish your wages for years. So let's break down those three numbers you see on your policy, like 50/100/25. This isn't just insurance jargon. It's a code that defines the absolute maximum your insurance company will pay out on your behalf after you cause an accident. Think of them as three separate buckets of money. The first number, in our example, the 50, stands for $50,000. This is your bodily injury liability limit per person. It's the maximum amount your insurance will pay for the medical expenses of any one single person you injure in an accident. $50,000 might sound like a lot of money. It's not. Let's paint a picture. You're running a little late, you glance down at your phone for just a second, and you run a red light T-boning another car. The driver of the other car, let's call her Susan, is rushed to the hospital with a broken femur. First, there's the ambulance ride. In many parts of the country, that's easily $2,000 to $3,000 right there. Then the emergency room visit, x-rays, MRIs, doctor consultations, that can be another $5,000 to $10,000. Now for the surgery to set her broken leg with plates and screws. You're looking at $20,000 to $30,000 minimum. After surgery, she'll need a hospital stay for a few days, adding another $10,000. We're already pushing $50,000, and we haven't even talked about the weeks of physical therapy she'll need to learn to walk again. Or the fact that she's a freelance graphic designer who can't work for 3 months, meaning she has thousands in lost wages. Suddenly, that $50,000 limit has been completely exhausted. And every single dollar of medical bills, physical therapy, and lost income above that $50,000, that is now your personal responsibility. Susan's lawyer won't just stop when the insurance money runs out. They will come after you for the rest. But it gets worse. Let's look at the second number. the 100 in our 50/100/25 example. This stands for $100,000, and it's your bodily injury liability limit per accident. This is the absolute maximum total your policy will pay for the medical expenses of everyone you injure in a single crash combined. Let's go back to that accident. When you hit Susan's car, she wasn't alone. Her husband was in the passenger seat, and their 2 kids were in the back. Her husband suffered a severe concussion and whiplash. His medical bills are $30,000. One of the kids has a broken arm and needs surgery, costing $25,000. The other child, thankfully, just has cuts and bruises, but the ER visit and follow-up still cost $5,000. So let's do the math. Susan's bills hit your $50,000 per person limit. Her husband's bills are $30,000. The first child's are $25,000. The second child's are $5,000. The grand total is $110,000 in medical bills for the family. Your policy's per accident limit is $100,000. Even though no single person went over the $50,000 individual limit, Susan's costs were capped at $50,000 by the policy. The total for everyone involved is more than the $100,000 bucket. Your insurance company writes a check for $100,000 and then they're done. They wash their hands of the situation. That remaining $10,000, plus any future costs or pain and suffering lawsuits. Again, that's on you. And we still haven't even talked about fixing their car. That brings us to the third number, the 25 in our 50/100/25 example. This stands for $25,000, and it is your property damage liability limit. This is the maximum amount your insurance will pay to repair or replace any property you destroy in an accident. This is mainly the other person's car, but it could also be a city light post, a homeowner's fence, a storefront, anything you hit. $25,000. Let that sink in. The average price of a new car in the United States is now close to $50,000. The average price of a used car is nearly $30,000. You T-boned Susan's brand new SUV. It's completely totaled. The replacement cost is $55,000. Your insurance policy, with its pathetic $25,000 limit, pays that amount. The other $30,000 to make that family whole, to give them back the vehicle they need to get to work and take their kids to school? It's your problem. So now, because you carried what's known as state minimum or basic coverage, you are personally on the hook for $10,000 in remaining medical bills and $30,000 for their car. You are facing a $40,000 lawsuit, and that's before their attorney adds on pain and suffering, emotional distress, and legal fees. A simple mistake, a moment of distraction, has now led to a bill that could easily exceed $100,000, a bill that your insurance only covered about half of. This is the state minimum trap. Nearly every state mandates that drivers carry a minimum amount of liability insurance to legally be on the road. Insurance companies love to advertise these super low rates. Get legal for just $39 a month. What they don't tell you is that these minimum limits, often 25/50/25 or even lower, are a financial time bomb. They are not designed to protect you. They are designed to provide the barest minimum safety net for the people you might hit. They exist to make sure that if you cause an accident, there's something there, but they do almost nothing to protect your own financial future. When you are underinsured, and the damages you cause exceed your policy limits, the other party's attorney will sue you personally. They will perform an asset search. They will look at your savings account, your checking account, the equity in your home, your retirement funds, your investments. They can get a judgment against you that allows them to garnish your wages, taking a percentage of every single paycheck you earn until the debt is paid. It can follow you for decades, destroying your credit and making it impossible to get a loan or buy a house. It can force you into bankruptcy. All of this sounds terrifying because it is. But here is the single most valuable piece of information in this entire series. Increasing your liability limits is shockingly inexpensive. Going from a dangerously low 50/100/25 policy to a much safer 100/300/100 policy might only cost you an extra $10 or $15 a month. Going up to 250/500/100, which is what most financial experts recommend to truly protect a middle-class family's assets, might be less than the cost of a few cups of coffee each month. You are paying pennies on the dollar to increase your financial shield from $50,000 to $250,000. There is no better return on investment for your peace of mind. So you take this advice. You call your insurance agent, you spend the extra $12 a month, and you get robust liability coverage that protects your family's future. You've done the responsible thing. You're protected if you cause an accident. But what if you do everything right? You get great liability coverage, you drive safely, and then you're the one sitting at a red light when someone texting and driving someone with zero insurance plows into the back of you? Your brand new, high-limit liability coverage won't pay you a single penny to fix your car or cover your medical bills. Remember, it only pays for the other guy. So what happens now? Who pays for you? That's where two little-known coverages come in, and they might be the most underrated lifesavers on your entire policy. The first is called Uninsured Motorist Coverage, and the second is Medical Payments Coverage. Let's break them down, because ignoring them is one of the biggest gambles you can take on the road. Imagine this. You're driving home, stopped at a red light, listening to your favorite podcast. Suddenly, bam, you're jolted forward. A car behind you wasn't paying attention and plowed right into your bumper. You're okay, just shaken up. You get out, the other driver gets out, they're incredibly apologetic. You exchange information, but when you call your insurance agent the next day, you get the worst possible news. The driver who hit you, they have no insurance. Zero. They've been driving illegally for months. Your heart sinks. Your car has a few $1,000s in damage. Your neck is starting to feel really stiff. Who is going to pay for this? The other driver is clearly at fault, but they have no money and no insurance. You can't squeeze blood from a stone. This is the exact nightmare scenario where uninsured motorist coverage, or becomes your absolute hero. Think of uninsured motorist coverage as a stand-in. It's a phantom insurance policy that you buy for the other guy, just in case he doesn't have one himself. When an uninsured driver hits you, your own coverage kicks in and acts exactly like the liability insurance they should have had. It steps into their shoes to pay for your damages. Now, coverage typically comes in two flavors. The first is uninsured motorist bodily injury, or UMBI. This is the big one. This covers your medical bills, your passengers' medical bills, pain and suffering, and even lost wages if you can't work because of the injuries you sustained in an accident caused by an uninsured driver. If that driver had fled the scene, a hit and run, your UMBI would also typically cover you. This coverage is, without exaggeration, a financial lifesaver. A single trip to the emergency room can cost thousands, and a serious injury can lead to hundreds of thousands in bills. Without UMBI, that financial burden would fall squarely on your shoulders. The second flavor is uninsured motorist property damage, or UMPD. As the name suggests, this covers the damage to your car. So in our red light scenario, your UMPD would pay to fix your crumpled bumper. However, there's a catch. Not every state offers UMPD, and in the states that do, it often comes with a deductible. More importantly, it often has a much lower limit than the other part of your policy designed to fix your car, which is collision coverage. We'll get to that in the next part, but for now, just know that while UMPD is good, relying on it alone to fix your car can be a risky move. The real superstar here is the bodily injury part. But let's add a twist to our story. What if the other driver wasn't completely irresponsible? What if they did have insurance, but they only bought the absolute bare minimum required by law? This is an incredibly common scenario. Let's say your state requires a minimum of $25,000 in bodily injury liability. So the driver who hit you has that $25,000 policy. But your injuries are serious. After the ambulance, the hospital stay, the physical therapy, your medical bills total $75,000. The other driver's insurance pays out its maximum of $25,000, and then they wash their hands of it. They've fulfilled their legal obligation, but you're still left with a $50,000 hole. A massive, terrifying $50,000 bill that you are now responsible for, even though the accident was 100% not your fault. This is where the second half of this dynamic duo comes in. Underinsured motorist coverage, or UIM. It works just like uninsured motorist coverage, but it applies when the at-fault driver has insurance, but just not enough to cover your bills. In this case, your UIM coverage would step in to cover that $50,000 gap, up to the limits of your UIM policy. This is why it is so critically important to look at your UM/UIM limits. Most people just match them to their liability limits. If you have 100/300 liability, get 100/300 for your UM/UIM. You are essentially buying protection for yourself that's as good as the protection you're required to buy for others. You're betting on yourself. Given that the Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured, it's a pretty smart bet to make. So, uninsured and underinsured motorist coverage is your shield against the financial fallout from irresponsible drivers. It's a long-term protector for your health and your savings. But what about the immediate aftermath? UM/UIM claims can sometimes take a while to process, especially if fault is being determined. But the hospital, the ambulance company, the chiropractor, they want to be paid now. This brings us to the second underrated lifesaver on your policy. Medical payments coverage, often called MedPay. Some states have a turbocharged version of this called Personal Injury Protection, or PIP. Let's start with MedPay. MedPay is beautifully simple. It's a small bucket of money, typically ranging from $1,000 to $10,000, set aside specifically to pay for immediate medical expenses for you and anyone in your car following an accident, regardless of who is at fault. Let me repeat that last part because it's the magic key, regardless of who is at fault. If you run a stop sign and hit a pole, your MedPay can cover your emergency room copay. If someone rear-ends you at a red light, your MedPay can cover the ambulance ride before you even know the other driver's name. It's immediate, no questions asked medical coverage. It's designed to be fast. There's no deductible. You just submit the bill and it gets paid up to your coverage limit. A lot of people think, well, I have good health insurance. Why do I need MedPay? It's a fair question. But here's why it's so valuable. First, your health insurance has a deductible. A major accident could easily mean you have to pay thousands out of pocket before your health insurance kicks in. MedPay can pay that deductible for you. Second, health insurance has copays and coinsurance. MedPay can cover those too. Third, your health insurance might not cover certain treatments, like chiropractic care or specific dental work resulting from an accident. MedPay often does. And finally, it covers your passengers. If you're driving your friends to lunch and get in an accident, your MedPay can help cover their initial medical bills, which is a much more comfortable situation than asking them to use their own insurance for an accident that happened in your car. Now, if you live in what's called a no-fault state like Florida, Michigan, or New York, among others, you'll likely have something called Personal Injury Protection, or PIP, instead of or in addition to MedPay. Think of PIP as MedPay on steroids. Like MedPay, it covers your medical bills regardless of who is at fault. But PIP goes much further. It can also cover lost wages. If you have to miss 2 weeks of work to recover from your injuries, your PIP coverage can help replace that lost income. It can also cover what are called replacement services. Say you break your leg and can't do chores around the house or take care of your kids. PIP can help pay for someone to come clean your house or provide childcare while you recover. In the most tragic cases, it can even provide a funeral expense benefit. The required amounts for PIP vary wildly by state, and the rules can be complex, but the core idea is the same. To make sure that anyone injured in a car accident has immediate access to funds for medical care, and to minimize financial disruption to their life, without having to wait for a long, drawn-out process of determining who is at fault. So let's put it all together. You've been hit by another driver. What's your financial safety net? First, your MedPay or PIP immediately kicks in to pay for that ambulance ride in your ER visit. No questions asked. This takes the immediate pressure off. Then you find out the other driver has no insurance. Now your uninsured motorist bodily injury coverage steps in to handle the major medical bills, the follow-up surgeries, and your lost wages. It saves you from financial ruin. Or you find out the other driver has minimum limits insurance that won't cover everything. Your MedPay still pays first, and then your underinsured motorist coverage comes in to pay the massive amount left over after the other guy's tiny policy is exhausted. You see how these pieces work together? Liability protects your assets from others. But UM/UIM and MedPay/PIP protect you. They protect your body, your health, and your financial future from the two biggest risks on the road: irresponsible drivers and the immediate, crushing cost of an injury. We've now covered how to protect yourself from lawsuits and how to pay for your medical bills. But we've left out the single biggest piece of the puzzle for most people. What about your car? That $20,000, $30,000, $50,000 piece of metal sitting in the tow yard with a smashed front end. Who pays to fix that? Uninsured motorist property damage might help a little, but it's often not enough. This is where the two most famous coverages of all come into play, the ones people think of when they hear full coverage. And understanding how they work is the key to making sure you can actually get your car back on the road. Let's start with the first one, collision coverage. The name is pretty straightforward. This is the coverage that pays to repair or replace your own car if it's damaged in a collision with another object. And that object is a key word. Most people think it just means another car, and it certainly does cover that. If you rear-end someone, your liability coverage pays for their car, and your collision coverage pays for yours. But it also covers you if you hit a stationary object. Back into a light pole in a parking lot? That's a collision claim. Swerve to avoid a squirrel and hit a guardrail? Collision claim. Accidentally drive into your own garage door? Yes, that's also a collision claim. It's the coverage for when you, the driver, are at fault for damaging your own vehicle in an impact. Now, here's the most important part of collision coverage, the part that trips everyone up. The deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before your insurance company starts paying. Think of it as your share of the cost. The most common deductible amounts are $500 or $1,000. Let's say you have a $500 deductible. You back into that light pole, and the body shop says it's going to cost $3,000 to fix your bumper and trunk. You are responsible for the first $500. You pay that to the body shop, and your insurance company pays the remaining $2,500. If the damage was only $400, you just pay for it yourself because it's less than your deductible. There would be no point in even filing a claim. Choosing your deductible is a balancing act. A higher deductible, like $1,000, means you'll pay less for your insurance every month. Your premium will be lower, but it also means you need to have $1,000 ready to go if you get into an accident. A lower deductible, like $500, means you'll pay more each month in premiums, but your out-of-pocket costs will be lower if you have to make a claim. It's a classic trade-off between short-term savings and long-term risk. So that's collision. It covers your car when you hit something. But what about all the other ways your car can be damaged? What about the things that are completely out of your control? That's where the second hero of our story comes in. Comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from almost everything except a collision. This is the coverage for the curveballs life throws at you. A hailstorm rolls through and leaves your car looking like a golf ball? That's a comprehensive claim. A heavy branch from a tree snaps off during a windstorm and crushes your roof? Comprehensive. You walk out to your car in the morning and find someone has keyed the side of it or smashed a window. Vandalism is covered by comprehensive. And what if you walk out and your car is just gone? Stolen? That's a comprehensive claim too. One of the most common comprehensive claims, especially in rural and suburban America, is hitting an animal. If a deer jumps out in front of you on the highway and you hit it, that is not a collision claim. It's a comprehensive claim. This is a weird distinction that confuses a lot of people. But the logic is that the animal is an unpredictable, moving hazard, more like an act of God, than a stationary object you collided with. However, if you swerve to miss the deer and you hit a tree instead, that flips back to being a collision claim. It's a strange but important detail. Just like collision, comprehensive coverage has its own separate deductible. You might have a $500 deductible for collision and a $250 deductible for comprehensive. They operate independently, so if a rock flies up from the highway and cracks your windshield, and the replacement costs $700, you'd pay your $250 comprehensive deductible, and insurance would cover the rest. So now we have these three core pieces: liability to protect others and collision and comprehensive to protect your own car. When you have all three of these on your policy, this is what people in the industry and on the car lot call full coverage. And I have to tell you, this is one of the most misleading phrases in the entire world of insurance. There is no policy you can buy called the full coverage policy. It's just slang. It's a shorthand way of saying you have the big three, but it is not a magic shield that covers you for everything. And believing that it does can lead to some nasty financial surprises down the road. It's just a starting point. The first question you have to ask yourself is, do I even need collision and comprehensive? Unlike liability insurance, no state legally requires you to carry them. This is a choice. Well, for many people, it's not actually a choice. If you have a loan on your car, or if you're leasing it, your lender or leasing company will absolutely require you to have both collision and comprehensive coverage, with a deductible no higher than a certain amount, usually $1,000. Why? Because until you pay off that loan, the bank is the true owner of that car. That vehicle is their asset, their collateral. They need to make sure that if you wreck it, their investment is protected. They'll get their money back from the insurance company so you can pay off the loan for a car that no longer exists. If you try to drop these coverages while you still have a loan, the bank can, and will, buy a very expensive policy on your behalf and add the cost to your car payment. But what if you own your car outright? No loan, no lease. The title is in your name. Now the decision is entirely up to you. And it comes down to a simple question. If your car were totaled tomorrow, could you afford to replace it without financial hardship? To answer that, you need to understand a very important concept called actual cash value, or ACV. Insurance doesn't pay you what you paid for the car. It doesn't pay for a brand new replacement. It pays you what your specific car, with its age, mileage, and condition, was worth in your local market the second before the accident occurred. That's its actual cash value. So you might have bought your car for $30,000 5 years ago, but today its ACV might only be $12,000. That $12,000 minus your deductible is the absolute maximum you will ever get from your insurance company for that car. So, if your car is only worth $2,000 and you have a $1,000 collision deductible, is it worth paying, say, $60 a month for collision coverage? You'd be paying over $700 a year to protect yourself from a maximum $1,000 loss. At that point, you might be better off dropping collision and comprehensive, banking the money you save on premiums, and self-insuring. You're essentially betting on yourself to be a safe driver and accepting the risk that if you wreck the car, you'll have to pay to replace it yourself. A good rule of thumb many financial advisors use is this. If the annual cost of your collision and comprehensive premium is more than 10% of your car's actual cash value, it's time to seriously consider dropping them. This brings us to the dreaded scenario. What does it mean for a car to be totaled? A car is declared a total loss not just when it's a twisted piece of metal, but when the estimated cost of repair approaches or exceeds its actual cash value. Every insurer has a different threshold, usually around 75 or 80% of the car's ACV. Let's go back to that car with a $12,000 ACV. You get in an accident, and the body shop estimates the repairs will cost $10,000. Since $10,000 is more than 80% of $12,000, the insurance company will likely declare it a total loss. They won't pay the $10,000 to fix it. Instead, they will write you a check for the car's actual cash value, $12,000, minus your deductible. So you'd get a check for $11,000 if you have a $1,000 deductible. They then take possession of your wrecked car and usually sell it for salvage. You're left with that check to go out and try to find a new vehicle. Understanding actual cash value is the key. It manages your expectations and helps you decide if paying for collision and comprehensive is still a smart financial move for your specific car. But even if you have this so-called full coverage, you're still not fully protected. There are critical gaps that can leave you with devastating bills. What happens if the person who hits you is at fault but has no insurance at all? Or not enough to cover your car and your injuries? And what about your own medical bills regardless of who is at fault? That's where the standard full coverage package falls short. And it's where the next most often overlooked coverages become the most important money you'll ever spend. Let's paint a picture. You're driving home, obeying every law when suddenly a car runs a red light and T-bones you. It's a serious crash. Your car is mangled, and you're in a world of pain. The ambulance arrives. At the hospital, doctors tell you that you have a broken femur, 3 cracked ribs, and a concussion. The other driver, who was clearly at fault, walks away with a few scratches. Then comes the gut punch. The police officer informs you that the other driver has no insurance at all. They let their policy lapse. Or worse, they never had it in the first place. Think about that. Your $100,000 hospital bill, the months of physical therapy, the wages you'll lose because you can't work. Who pays for it? The other driver? They don't have insurance, and it's a safe bet they don't have $100,000 sitting in the bank. You could sue them, sure. And maybe you'll win a judgment that says they owe you money. But as they say, you can't get blood from a stone. A piece of paper saying you're owed money is worthless if the person has no money to give. This is the nightmare scenario. Your liability coverage doesn't help you because you weren't at fault. Your collision coverage will fix your car, minus your deductible, but it won't touch your medical bills. Your health insurance might cover some of the hospital stay, but you'll be on the hook for deductibles, copays, and out-of-network specialists that could easily run into the tens of thousands. This is precisely where the first and arguably most important coverage we're talking about today becomes your financial superhero: Uninsured Motorist Bodily Injury Coverage, or UMBI. Uninsured motorist coverage is not for the other guy. It's for you. It is insurance you buy to protect yourself from people who break the law and drive without insurance. When an uninsured driver injures you, your own UMBI coverage steps in and acts like the at-fault driver's insurance policy that they should have had. It pays for your medical bills, your lost wages, your pain and suffering, up to the limits you selected. And this brings us to the most critical decision you will make on your policy: the limits. Most people just match their UMBI limits to their bodily injury liability limits. If you have 100/300 on your liability, you get 100/300 on your uninsured motorist. This is a fantastic rule of thumb. Why would you want to provide less protection for your own family than you would for a total stranger you might accidentally injure? You are essentially saying, if I hurt someone, they deserve up to $100,000. But if someone with no insurance hurts me, I'm only worth, what, $25,000? It makes no sense. You should value your own well-being at least as much as a stranger's. Now let's change the scenario slightly. The at-fault driver who T-boned you does have insurance. Relief, right? Not so fast. They have the state minimum policy. In many states, that might be just $25,000 or even $15,000 of bodily injury liability coverage. Your medical bills alone are $100,000. Their insurance company will cut you a check for their policy limit, say $25,000, and then they wash their hands of the situation. They have fulfilled their legal obligation. You are now left holding a bill for the remaining $75,000. This is where the second superhero swoops in. Underinsured Motorist Bodily Injury Coverage, or UIMBI. Underinsured motorist coverage protects you when the at-fault driver has insurance, but not enough to cover your damages. In our example, their policy pays the first $25,000. Then, your own underinsured motorist coverage kicks in to cover the rest, up to your policy limit. If you have $250,000 in UIMBI coverage, it can cover that $75,000 gap and then some, covering your lost wages and other damages. Together, uninsured and underinsured motorist coverages are your shield against the millions of irresponsible drivers on the road. In some states, nearly 1 in 4 drivers is uninsured. It's a gamble you cannot afford to take. Skimping on this coverage to save a few dollars a month is like removing the airbags from your car to save weight. It's catastrophically short-sighted. But what about your car? If an uninsured driver totals your brand new SUV, who pays for that? This is where uninsured motorist property damage, or UMPD, comes in. It functions just like the bodily injury version but for your vehicle. Now you might be thinking, wait, wouldn't my collision coverage pay for that? And you're right, it would. However, UMPD has 2 key advantages. First, the deductible is often much lower than a standard collision deductible, sometimes as low as $100 or even $0. Second, in some states, making a UMPD claim won't be counted as an at-fault accident on your record, which can save you from a rate increase. It's a small but powerful piece of the puzzle. Okay, so we've protected ourselves from the other guy. Uninsured, underinsured, we're covered. But let's go back to the moment the crash happens. The ambulance is on the way. The hospital is prepping the ER. These people want to be paid, and they want to be paid now. They don't want to wait weeks or months while insurance companies argue about who was at fault. And what if the accident was your fault? Or what if it was a single-car accident, like hitting a patch of ice and sliding into a tree? Or what if you're a passenger in your friend's car when they crash? Your uninsured motorist coverage won't help you here. This is where the final 2 absolutely essential coverages come into play. Medical payments coverage, known as MedPay, and personal injury protection, or PIP. Think of these as your on-demand, no questions asked medical coverage for a car accident. It doesn't matter who was at fault. If you are injured in, on, or around a vehicle, this coverage kicks in immediately to pay your medical bills up to the limit you choose. This is for you, your family members, and any passengers in your car. It covers the ambulance ride, the ER visit, x-rays, dental work if you chip a tooth on the steering wheel, even chiropractic care. MedPay is typically sold in amounts like $1,000, $5,000, or $10,000. It's incredibly inexpensive for the peace of mind it provides. A $5,000 MedPay limit might add only a few dollars to your monthly premium, but it can completely erase the health insurance deductible you'd otherwise have to pay out of pocket right after a crash. It pays first before your health insurance, with no deductible and no copay. In certain states known as no-fault states, they take this concept even further with personal injury protection, or PIP. PIP is like MedPay on steroids. It not only covers medical bills, but it also covers a percentage of your lost wages if you can't work. It can even cover things like hiring someone to do household chores you can no longer perform due to your injuries. In these states, PIP is mandatory, and it's your first line of defense for any injury, regardless of fault. The beauty of MedPay and PIP is the speed. While the liability portion of a claim is being investigated, your MedPay or PIP is already paying the doctors, so you don't have to stress about bills piling up while you're trying to recover. It's the ultimate financial first aid kit. So let's recap the fortress you've just built. You have liability to protect your assets if you hurt someone. You have comprehensive and collision to fix your own car. And now you've added the most critical personal protection layers. Uninsured and underinsured motorist coverage to pay for your injuries when someone else is at fault but can't pay, and MedPay or PIP to cover your immediate medical needs regardless of who is at fault. This is what a truly robust policy looks like. It's not just about being legal. It's about being smart. It's about creating a financial force field around you and your family. But now for the hard part. You have all this amazing coverage. You've paid your premiums diligently for years. You get into that accident, you file your claim, and you expect the insurance company, your own insurance company, to take care of you. But what happens when their first offer to settle your injury claim is a joke? An insultingly low number that doesn't even cover your bills? Knowing what coverages you have is only half the battle. The other half is knowing how to make the insurance company honor the promises they made to you in that policy. And that, my friends, is a completely different kind of fight. So let's step into the ring. The bell has just rung. Not in a boxing match but on the side of a road. It's the sound of crunching metal and shattering glass. You've just been in an accident. Your heart is pounding. Adrenaline is coursing through your veins. What you do in the next 60 minutes can determine the outcome of your entire insurance claim. This is where the fight begins. First, before you do anything else, check if everyone is okay. Your health and the health of others is the absolute priority. Call 911 immediately if there are any injuries, no matter how minor they seem. Even if no one is hurt, it's almost always a good idea to call the police to get an official report. That police report becomes an unbiased, third-party account of the incident, and it is pure gold for your claim. While you wait, turn your smartphone into your most powerful weapon. Take pictures of everything, and I mean everything. Get wide shots of the entire scene showing the position of the cars. Get medium shots of the damage to both vehicles. Then get close-ups of every single dent, scratch, and crack. Photograph the other car's license plate. Take pictures of skid marks, debris on the road, traffic signs, and even the weather conditions. You are creating a visual story that cannot be disputed later. Next, you exchange information. Get the other driver's name, address, phone number, and, critically, their insurance company and policy number. Offer them the same information from your own records. But this is where you must be incredibly careful. The one thing you do not do under any circumstances is admit fault. Don't say "I'm so sorry," or "I didn't see you." Adrenaline can make you want to apologize, even if it wasn't your fault. But those simple words can be twisted and used against you by an insurance company as an admission of guilt. Be polite, be cooperative, but be quiet. Stick to the facts. Let the police and the insurance companies figure out who was at fault. Okay, the scene is cleared, you're home, and the adrenaline is starting to wear off. Now you have to make a choice. Who do you call? Your insurance company or the other drivers? This is a crucial strategic decision. If you call your own insurance company, you are opening what's called a first-party claim. You are their customer. They have a contractual duty to you. If you have collision coverage, they will handle your repairs minus your deductible, and then they will go after the other driver's insurance to get their money back, a process called subrogation. They'll also get your deductible back for you in that process. This is often the faster, more streamlined path. If you call the other driver's insurance, you're opening a third-party claim. To them, you are not a customer. You are a liability. You are a problem they want to go away as cheaply as possible. Their legal duty is to their own shareholder and their own policyholder, not to you. While you can file directly with them to avoid paying your deductible upfront, you are entering the lion's den alone. Soon after you file, you'll be assigned a claims adjuster. Let's be very clear about who this person is. The adjuster's job is not to be your friend. Their job is to investigate the claim and resolve it for the lowest possible cost to their company. They control the money. They are trained negotiators and they handle hundreds of these cases a year. You might handle one in a decade. The information imbalance is staggering. This is why your documentation is so important. Create a folder, a physical one and a digital one. Every email, every letter, every photo, every receipt goes in the folder. Every time you speak to the adjuster on the phone, take notes. Write down the date, the time, who you spoke to, and a summary of what was said. This isn't paranoia. It's preparation. You are building a fortress of facts, and every note is a stone in the wall. Now we come to one of the most critical and most dangerous moments in any claim, the recorded statement. The adjuster will call you, sounding friendly and concerned. They'll say, I just need to get your side of the story on a quick recorded line to move things forward. Sounds harmless. It is anything but. A recorded statement is not a friendly chat. It is a formal, on-the-record interview that can and will be used against you. The adjuster is trained to ask questions in a specific way to get you to say things that minimize their company's liability. They might ask, "So you were a little distracted right before the impact?" Or, "How fast would you say you were going?" They are looking for inconsistencies, admissions, and doubts. They will ask you about your injuries. If you say, "I'm fine," even if you're just being polite, they'll note it. When you later realize you have whiplash, they'll pull out that recording and say, "But on the day of the accident, you said you were fine." So what do? You are generally required to cooperate with your own insurance company, which may include giving a recorded statement. But you are under absolutely no obligation to give a recorded statement to the other driver's insurance company. You can, and often should, politely decline. You can say, "I'm not comfortable giving a recorded statement at this time. All the necessary facts are in the police report." If you must give a statement to your own insurer, prepare for it like an exam. Review your photos and your notes. Stick to the absolute, undeniable facts. Do not guess. Do not estimate. Do not offer opinions. If you don't know the answer, say, "I don't know," or "I don't recall." Answer only the question that was asked. Don't volunteer extra information. Keep your answers short and direct. Where were you going? To the grocery store. Not, "Well, I was running late to the grocery store because my kid was sick and I was a bit flustered." One is a fact, the other is a narrative they can use. While this is happening, you also have to deal with your car. The insurance company will want to send an appraiser to look at the damage, or have you take it to one of their approved repair shops. These shops often have agreements with the insurer to use certain parts, sometimes aftermarket or reconditioned parts instead of original manufacturer parts, to keep costs down. You have the legal right in most states to have your vehicle repaired at any shop of your choosing. It may be easier to use their recommended shop, but if you have a trusted mechanic, you can insist on taking it there. The insurer is still obligated to pay for reasonable repairs, but you may have to fight for it. And if you were injured, the stakes get infinitely higher. You'll be using your MedPay or PIP coverage, and the adjuster will be asking for access to all of your medical records. They aren't just looking at the records from this accident. They are often looking for pre-existing conditions or prior injuries they can use to argue that your current pain isn't their policyholder's fault. This entire process, from the crash scene to the recorded statement to the repair shop, is designed to filter information in the insurance company's favor. Every step is an opportunity for them to reduce what they owe. They have a playbook and they run it on every single claim. By documenting everything, by being careful with your words, and by understanding the true role of the adjuster, you are taking away their advantages. You are leveling the playing field. You are showing them that you will not be an easy, low-cost settlement. You've now laid the foundation. You've reported the claim, documented the evidence, and navigated the initial, treacherous interviews. You've gotten your car into the shop and started your medical treatment. Now the adjuster has all their initial information, and soon your phone will ring. On the other end will be the adjuster, ready to make you their first offer. And that first offer is where the real psychological game begins. That first offer is rarely, if ever, about making you whole. It's an opening bid in a negotiation you didn't even know you were in. It's a test. They are testing your knowledge, your resolve, and most importantly, your desperation. The number they give you isn't based on a deep, empathetic understanding of your pain, your sleepless nights, or the future physical therapy you might need. It's often generated by a sophisticated software program, a cold algorithm that has analyzed thousands of similar claims. Its purpose isn't fairness. Its purpose is profit. It's designed to find the lowest possible number that a statistically significant percentage of people will accept just to make the whole nightmare go away. And this is the first, most critical thing you must understand. The adjuster's job is not to be your friend. They might sound friendly, they might be polite, they might express sympathy for your situation. But their professional mandate, the very metric by which their performance is measured, is to close your claim for the lowest amount of money in the shortest amount of time. Every dollar they don't pay you is a dollar that stays on their company's bottom line. You are a line item on a spreadsheet, a case file in a queue, and their goal is to move you from the open column to the closed column as efficiently as possible. So, when they make that first offer, you have to resist every natural human instinct to be agreeable or to feel relief that a number is finally on the table. Your response in this moment will set the tone for everything that follows. The absolute worst thing you can do is accept it. The second worst thing is to get angry and emotional. Emotion is a currency they are happy to trade in because an emotional person is a predictable person, and a predictable person is easy to manage. Instead, your response should be calm, measured, and simple. You don't have to reject it on the spot. You don't have to counter. You simply say, "Thank you for providing that. I'm going to need some time to review it and compare it against my records. Can you please send me that offer in writing?" That's it. You've done 3 crucial things with that simple sentence. First, you've taken back control of the timeline. They want to create urgency to make you feel like this is a fleeting opportunity. You've just told them you work on your own schedule. Second, you've signaled that you are organized. The phrase "compare it against my records" tells them you aren't just thinking about this off the cuff. You have documentation. Third, and most importantly, you've demanded a paper trail. A verbal offer can be misunderstood or denied. A written offer is a hard starting point for the real negotiation. Now, while you wait for that written offer, you prepare your counter. This is where you assemble your own version of the story. Not with emotion, but with cold, hard facts. You need to build a fortress of documentation. This includes every single medical bill, from the ambulance ride to the last physical therapy session. It includes every prescription receipt. It includes a formal letter from your employer documenting the exact amount of wages you lost because you couldn't work. It includes the written estimates for your car repair from at least 2 different, reputable shops, not just the one the insurance company recommended. But here's the part that most people miss, the part that separates a small settlement from a fair one. You must document your pain and suffering. Insurance companies hate this part because it's not a simple line item. It's subjective, and so they will try to minimize it or ignore it completely. Your job is to make it impossible to ignore. How do you put a price on pain? You start by documenting its impact. Keep a simple daily journal after the accident. Don't write pages and pages of emotional prose. Be factual. Day 3, pain in my neck was a 7 out of 10. Could not turn my head to the left to back out of the driveway. Had to ask my spouse to do it for me. Could not lift my child out of their crib. Day 10. Still experiencing headaches. Had to leave work 2 hours early. Missed my son's soccer game because the bright lights made the headache worse. This journal transforms a vague complaint of, "I was in pain," into a concrete record of a diminished quality of life. It's evidence. When you can say, "For 47 days, I was unable to perform basic household chores or participate in my family's life," that has a weight and a value that "my back hurt" simply does not. Once you have all of this documentation, your medical bills, we call these medical specials, your lost wages, and your pain journal, you are ready to formulate your counteroffer. This is typically done in the form of a formal demand letter. You don't need a lawyer to write one, but it needs to be professional and structured. It should clearly lay out the facts of the case. The date of the accident, the other driver's fault, and a summary of the events. Then you list your hard cost. You add up every single medical bill, every dollar of lost wages, every out-of-pocket expense. Let's say that total comes to $10,000. This is your baseline. Next, you calculate your general damages, which is the legal term for pain and suffering. A common method used as a starting point is the multiplier method. You take your total hard costs, that $10,000, and you multiply it by a number typically between 1.5 and 5. The multiplier depends on the severity of your injuries. A sprained wrist that heals in 3 weeks might be a 1.5. A broken leg requiring surgery and 6 months of rehab could be a 4 or a 5. So, if your injuries were significant, you might use a multiplier of 3. $10,000 in hard costs times 3 equals $30,000 for pain and suffering. You add that to your original $10,000, and your total demand is $40,000. In your letter, you don't just state the number. You justify it. You reference your pain journal. You explain the impact the accident had on your life, using the specific examples you documented. You attach copies of every bill and every receipt. You are not just asking for money. You are presenting an evidence-based case for why you are entitled to that specific amount. You send this letter certified mail so you have a record of them receiving it. And then you wait. The adjuster will call back. They will almost certainly not accept your demand. They will likely come back with a second offer, higher than their first but much lower than your demand. They will try to poke holes in your case. They'll say, "Well, you waited 2 days to see a doctor." You'll respond, "Adrenaline can mask injuries, as is well documented, and I went as soon as the pain became apparent." They'll say, That physical therapist you saw is known for overtreating. You'll respond, I was referred to them by my primary care physician, and I followed my doctor's treatment plan precisely. Never lose your cool. Every time they challenge a point, you respond with a fact or a piece of documentation. The entire conversation is a chess match. They make a move, you counter. They are trying to wear you down. They are counting on you to get tired, frustrated, and to just give in. Your job is to be a calm, polite, and unmovable wall of evidence. If they refuse to budge from an unreasonable number, you can escalate. You can politely ask to speak to their supervisor. You can mention that you are considering filing a formal complaint with the state's Department of Insurance, which is a headache they do not want. And then, there is the final card you can play. You can say, it seems we're too far apart on this. I think I'm going to need to get some legal advice on how to proceed. The moment the word attorney or lawyer is introduced, the entire dynamic of the claim can change. The case file is often moved to a different department. The adjuster knows that the cost for the insurance company is about to go up exponentially. It doesn't mean you have to hire one, but the act of signaling that you are willing to can be enough to make them suddenly become much more reasonable. Through this process of calm, documented, and persistent negotiation, you will move their offer up bit by bit. Eventually, after a few rounds of back and forth, you'll likely arrive at a number that feels fair. A number that truly covers your expenses, compensates you for your lost time, and acknowledges what you went through. You'll feel a massive wave of relief. You've done it. You've stood up for yourself and won. You're ready to say yes, take the money, and finally put this all behind you. But agreeing on the number isn't the end of the game. It's just the end of the beginning. Because the document they send you next, the one you have to sign to get the check, is filled with legal language designed to protect them, not you. It's called a release of all claims, and it is a trap for the unwary. Signing it is a final, irreversible act, and if you don't understand exactly what it says, you could be giving up rights you never even knew you had, and closing the door forever on any future help you might desperately need. So let's pull back the curtain on that piece of paper, that release form. The insurance company isn't just trying to be efficient when they rush it to you. They are playing a strategic game, and the clock is their greatest ally. Every day that passes after an accident, the true cost starts to reveal itself. The next stiffness you thought was temporary might turn into a chronic issue, requiring months of physical therapy. The strange noise your car is making, the one the body shop missed, could be a sign of deeper, more expensive mechanical damage. The rental car fees pile up. The time you miss from work starts to hurt your paycheck. The insurance company knows this. They know that the initial estimate is just that, an estimate, a guess. Their first offer, the one attached to that release form, is designed to cap their losses before you figure out what your real losses are. Think of the insurance adjuster not as your enemy, but as a professional with a very specific job: to close your claim for the lowest amount that is legally and contractually permissible. They are the gatekeeper of the company's vault. They handle hundreds, maybe thousands of claims a year. You hopefully will handle one or two in your lifetime. This is a massive asymmetry of experience and information. They know the script. They know the pressure points. They might be friendly, they might be empathetic, but their performance is ultimately judged by how much money they save the company. So when that first offer comes in, often shockingly fast, you need to see it for what it is. An opening bid in a negotiation you didn't even know you were in. It's a test. They're testing to see if you're a pushover, if you're desperate for the cash, if you're unaware of your rights. Accepting that first offer is like a poker player folding their hand before they've even seen all the cards. You must resist the urge. Take a deep breath and recognize that this is just the beginning of the process, not the end. Your first move is to not make a move. Don't agree to anything verbally. Don't sign anything. Simply thank them for the offer and tell them you need time to review it and gather your own information. This is where you start building your case. You become the CEO of your own claim. You need your own independent estimates for repairs. Don't just rely on the preferred body shop the insurer sends you to. While many of these shops do good work, they have a business relationship with the insurance company. Their incentive is to keep costs down to continue getting referrals. Get 2 or 3 of your own quotes from highly rated independent shops that work for you, not the insurer. These shops are more likely to spot hidden damage and fight to use original manufacturer parts, not cheaper aftermarket ones. But the cost of repairs is only one piece of the puzzle. There is a concept that insurance companies absolutely hate talking about. It's a secret they don't want you to know, because it can cost them thousands. It's called diminished value. Diminished value is the loss in your car's resale value, simply because it now has an accident history. Think about it. If you were buying a used car, and you had two identical models for the same price, but one had a clean history and the other had been in a major collision, which one would you buy? The one with the clean history every single time. That's diminished value in action. Even if the repairs are perfect, flawless, the car now carries a financial scar. That accident report will follow it for the rest of its life, and when you go to sell it or trade it in, you will get less money for it. That's a real, tangible financial loss caused directly by the accident. And in many states, you are entitled to be compensated for that loss. This isn't for a little fender bender. But if you have a newer car that sustains significant damage, the diminished value could be thousands or even tens of thousands of dollars. The insurer's adjuster will almost certainly not bring this up. You have to be the one to raise it. You have to demand it. You'll likely need to hire an independent appraiser who specializes in diminished value claims to produce a professional report. It's a fight, and you may not win, as laws vary by state and the specifics of your policy matter. But for many people, it's a fight worth having, because it's money you are legitimately owed. And what about your body? The medical side of a claim is even more treacherous. An insurance company might offer you $5,000 to settle your injury claim a week after the accident. You might feel a little sore, but you think, $5,000 sounds pretty good right now. You sign the release. 6 months later, you're diagnosed with a herniated disc from the accident that requires surgery, and will cause you pain for the rest of your life. The cost? Potentially hundreds of thousands of dollars over a lifetime in medical bills and lost wages. But because you signed that release, that door is closed. Forever. You can't go back and ask for more. You traded your long-term health for a quick, small check. This is why you never, ever settle an injury claim until your doctor tells you that you have reached maximum medical improvement. A fancy term for saying you're either fully healed or as healed as you're ever going to get. But let's say you navigate all of this perfectly. You negotiate a fair settlement, you get your car fixed, your medical bills are paid. The story isn't over. Now comes the sequel. The impact on your insurance rates. The single biggest fear for most drivers after a claim is, will my rates go up? The answer almost always is yes, especially for an at-fault accident. Your insurer now sees you as a higher risk. That good driver discount you had? Gone. You'll likely see a surcharge added to your premium for the next 3 to 5 years. This surcharge can be significant, costing you hundreds or even thousands of extra dollars over time. In a cruel twist of irony, the very act of using the insurance you've been paying for can make that insurance more expensive. And it's not just at-fault accidents. In some states and with some insurers, even not at-fault accidents can trigger a rate increase or the loss of a claims-free discount. Why? Because the data might suggest that people who are involved in any kind of accident, regardless of fault, are statistically more likely to be in another one later. Even comprehensive claims like hitting a deer or having a tree fall on your car can sometimes lead to a rate hike if you have too many of them in a short period. But a rate hike isn't the worst-case scenario. The ultimate power the insurance company holds over you is the power of non-renewal. They can decide to drop you. After a major at-fault accident, or a series of smaller claims, your insurer might send you a letter saying they will not be renewing your policy. This marks you. Suddenly, you're in the market for new insurance, but you're now considered high risk. Other insurance companies will see your claims history and either refuse to cover you or offer you coverage at an astronomical price. You can be forced into what's known as the non-standard market, which is insurance for people considered too risky for mainstream carriers, and the premiums are brutal. This is the long tail of a car accident. It's not just about the immediate aftermath. It's a financial echo that can last for years, affecting your budget and your ability to even legally drive your car. So when do you raise the white flag and call for backup? When do you stop being the CEO of your own claim and hire a professional? If you have a simple, minor property damage claim where fault is clear, you can probably handle it yourself. But the moment certain red flags appear, you need to seriously consider getting help. If the other driver's insurance company is disputing fault, if your injuries are serious or require ongoing treatment, if the settlement offer is insultingly low and they won't budge, or if you're dealing with a diminished value claim on a high-value vehicle, it's time to call in a lawyer. A personal injury attorney who specializes in car accidents understands this game better than anyone. They know the tactics, they know what a claim is really worth, and the mere presence of a lawyer often makes an insurance company take a claim far more seriously. They work on contingency, meaning they only get paid if you win, taking a percentage of the settlement. For many, this is the only way to level the playing field against a multi-billion-dollar corporation. Navigating a claim is a reactive process. It's what you do after the damage is already done. But how do you protect yourself before the worst happens? How do you build a policy so robust, so ironclad, that it can withstand the storm of a major claim and give you the ammunition you need to fight back? That's about understanding the secret language of your policy, the optional coverages, the endorsements, and the exclusions you've probably never even read. Let's decode that secret language right now. Using the story of a guy named Dave. Dave is a good driver, pays his premiums on time, and thinks he has full coverage. But on a rainy Tuesday afternoon, his definition of full is about to be tested. A car runs a stop sign and T-bones him. Everyone is okay, thankfully, but his car, his reliable four-wheeled partner, is a mangled mess. The tow truck arrives. The driver asks Dave for his credit card. Dave is confused. Doesn't my insurance cover this? The tow driver just shrugs. Sometimes. This is Dave's first lesson in optional coverages. What he needed was towing and labor coverage. It's usually an incredibly cheap add-on, maybe a few dollars a month. It covers the cost of towing your vehicle to a repair shop if it's disabled. Some policies even cover things like a flat tire change, a jump start, or running out of gas. For the price of a fancy coffee once a month, Dave could have avoided that first unexpected $100 hit right at the scene of the accident. But the financial surprises are just getting started. The body shop tells him the car is fixable, but it's going to take at least 2 weeks to get the parts and do the work. Dave needs to get to his job. He needs to pick up his kids. He needs a car. He calls his insurance company, confident they'll provide a rental. The agent on the phone is polite but firm. "I'm sorry, Mr. Henderson, but your policy doesn't include rental reimbursement." This is the second and much bigger gut punch. Rental reimbursement is another optional coverage that pays for a rental car, while yours is being repaired after a covered claim. Without it, Dave is looking at a bill of $40, $50, maybe $60 a day for 2 weeks. That's over $700 out of his own pocket, all because he didn't check a box that might have cost him $5 a month. When you buy this coverage, pay close attention to the limits. You'll see something like 30 of 900. This means the policy will pay up to $30 per day, for a maximum total of $900 per claim. In today's market, $30 a day might only get you the most basic compact car, so it's often worth paying a little extra to upgrade that daily limit to $50 or $60. A week later, Dave gets another call. This one is from the body shop manager. "Hey Dave, we're almost done, but I have to talk to you about the wheels." Dave had spent $2,000 on a beautiful set of custom alloy wheels a year ago. They were his one big splurge for the car. The manager continues, "Your insurance adjuster was here, and they're only covering the cost of the factory stock steel wheels that came with your car's trim level. The difference is about $1,500. Dave is floored. This is a lesson in custom parts and equipment coverage, or CPE. Your standard auto policy is designed to restore your car to its factory condition, and nothing more. If you've added a custom stereo, expensive wheels, a new paint job, or performance enhancements, they are not covered unless you add a CPE endorsement. You have to specifically tell your insurance company about these upgrades and pay a little extra to protect your investment. Otherwise, in the event of a claim, they'll pretend those upgrades never existed. But let's imagine a worse scenario for Dave. What if the damage was so bad the insurance company declared his car a total loss? They've determined the car's actual cash value. Its market value right before the crash is $15,000. They cut him a check for that amount minus his deductible. The problem? Dave is still paying off his car loan, and he owes the bank $18,000. The insurance check isn't even enough to pay off the loan, let alone buy a new car. He now has no car, and he still has to write a $3,000 check to the bank for a vehicle that's sitting in a scrapyard. This nightmare scenario is called being upside down on your loan, and it's terrifyingly common, especially with new cars that depreciate the moment you drive them off the lot. The shield against this is called gap insurance. GAP stands for Guaranteed Asset Protection. It's an optional coverage that pays the difference, the gap, between what your car is worth and what you still owe on your loan or lease. If Dave had gap insurance, his policy would have paid the $15,000 to the bank, and the gap coverage would have kicked in to pay the remaining $3,000. He would have walked away with no car but also no debt. So you see, these optional coverages, towing, rental, custom parts, gap, they aren't just little extras. They are the stitches that hold the safety net together. They fill the holes you don't know exist until you're already falling through them. But it's not just about what you can add to a policy. It's equally, if not more, important to understand what your policy explicitly takes away. These are the exclusions, the fine print that says, in this situation you are on your own. And the number one most misunderstood exclusion in the modern world is the business use exclusion. Your personal auto policy is for, well, personal use. Driving to work, getting groceries, going on a road trip. The moment you start using your car to earn money, you've likely voided your coverage. Think about it from the insurer's perspective. A delivery driver or a rideshare driver is on the road more, in unfamiliar areas, under time pressure. They are a much higher risk than a typical commuter. So if you're driving for Uber or Lyft, or delivering for DoorDash or Amazon Flex, and you get into an accident while your app is on, your personal insurance company can, and almost certainly will, deny your claim. They will say, you were engaged in commercial activity. You're not covered. The rideshare and delivery companies offer some insurance, but it often has huge gaps, especially when you're waiting for a ride or delivery request. The only way to be truly protected is to get a specific rideshare endorsement on your personal policy, or purchase a full commercial auto policy. Not telling your insurer you're using your car for this work isn't a clever way to save money. It's a gamble that could lead to financial ruin. Other exclusions are more obvious but still worth knowing. Your policy won't cover intentional acts. If you purposely drive your car into a lake, don't expect a check. It also doesn't cover normal wear and tear. Insurance is for sudden and accidental events, not for new tires, brake pads, or an engine that's simply old. Think of it like this: your health insurance covers a broken arm from a fall, but it doesn't cover the wrinkles you get from aging. Same principle. Racing is another big one. Whether you're on a professional track or just street racing with a friend, if you crash, you're on your own. Any damage to your car, or liability for others, will be denied. And what about your stuff inside the car? If your laptop or phone is stolen from your vehicle, your auto insurance won't cover it. That falls under your homeowner's or renter's insurance policy, under the personal property coverage. Your car insurance covers the car, not the cargo. Finally, there are endorsements that can add back very specific types of protection. For a few extra dollars, you can get an OEM endorsement. This stands for Original Equipment Manufacturer. It means that if you need repairs, the insurance company must pay for parts made by your car's original manufacturer, like Ford or Honda, instead of cheaper aftermarket parts. For people who are very particular about their vehicle, this provides huge peace of mind. You can even find niche coverages like pet injury protection, which helps with vet bills if your furry friend is hurt in an accident, or a new car replacement endorsement, which will buy you a brand new car of the same make and model if yours is totaled in the first year or two of ownership, instead of just giving you the depreciated cash value. Each of these clauses, these endorsements and exclusions, is a lever that can either save you from financial disaster or drop you right into it. They are the difference between an insurance policy that works for you and one that simply collects your money. Dave's Bat Tuesday could have been a minor inconvenience. Instead, it became a multi-thousand-dollar catastrophe, all because of the words he never read. He had the right liability limits. He had collision and comprehensive. He thought he was prepared. But the devil, as always, was in the details he'd ignored. Now, he's got the right coverages on his new policy. But the real test is yet to come. Because having the right policy is only half the battle. The other half is navigating the claims process itself. A world of adjusters, negotiations, and strategic delays designed to pay you as little as legally possible. And that is where the real fight begins. The moment the metal crunches, a clock starts ticking. The first hour after an accident is the most critical period for your entire claim. This is where you win or lose, not in an office weeks later, but right there on the asphalt. Your first instinct might be panic or anger, or even misplaced apology. Fight it. Your only job in those first few moments is to become a meticulous evidence-gathering machine. Before you do anything else, if anyone is hurt, call 911. Your health and the health of others is the absolute priority. But once that call is made, your focus shifts. Pull out your phone. You're not just taking one or two pictures. You're creating a complete, undeniable visual record. Take wide shots showing the entire scene, the position of the cars, the road conditions, the traffic signals. Then get closer. Photograph the damage to both vehicles from every conceivable angle. Get low, get high. Capture the license plates, the debris on the road, the skid marks. If there are injuries, document them. A picture of a bruised knee or a cut arm taken at the scene is 1,000 times more powerful than trying to describe it later. Never, under any circumstances, admit fault. Don't say, "I'm so sorry." Don't say, "I didn't see you." These phrases, born from politeness, will be twisted into legal admissions of guilt. You can be courteous, you can ask if the other person is okay, but you do not discuss the details of the crash. You exchange information: name, address, phone number, and insurance details. That's it. If there are witnesses, get their names and numbers. A neutral third-party account can be the single most valuable piece of evidence you have. Insist on a police report, even for a minor fender bender. That official report creates an objective record of the event that is incredibly difficult for an insurance company to dispute later on. Once you're safe and have gathered this initial evidence, you have to make the call to your insurance company. This call is a minefield. Remember, from the second you say hello, you are likely being recorded. The person on the other end of the line may sound friendly, like a helpful customer service agent, but their job is to protect the company's bottom line. Their goal is to gather information that can be used to minimize your claim. So what do you say? Stick to the facts. The bare, verifiable facts. State your name, your policy number, the date, time, and location of the incident. Describe the event in simple, neutral terms. A collision occurred involving my vehicle and another vehicle. You can describe the damage you see, but do not speculate on the cause of the accident or the extent of your injuries. If they ask if you're injured, and you feel even the slightest bit of pain, say, "I'm not sure yet, I'll be seeking medical attention." Adrenaline is a powerful painkiller. The whiplash or back injury you don't feel at the scene can become agonizing a day or two later. If you say, "I'm fine" on that recorded call, they will use those 2 words against you for the rest of the process. Soon after, you'll be assigned a claims adjuster. Let's be crystal clear about who this person is. They are not your advocate. They are not your partner. They are a highly trained professional whose performance is often measured by how much money they save the company. They are experts in negotiation, psychology, and strategic delay. Their first tactic is often speed. They'll call you quickly, sounding concerned and eager to help. They might make a fast settlement offer, sometimes within days of the accident. "Let's just get this taken care of. We can send you a check for $2,000 right now and you can put this all behind you." This is a trap. They are preying on your desire for the ordeal to be over. They are offering you a fraction of your claim's potential worth before you've even had a chance to see a doctor, get a proper repair estimate, or understand the full extent of your damages. Never accept the first offer. If you don't take the quick cash, the adjuster's demeanor might change. They will scrutinize every detail you provide. They'll question the repair estimate from your mechanic, suggesting you go to one of their preferred shops that often have agreements with the insurer to use cheaper, non-original parts. They'll pore over your medical records, looking for any pre-existing conditions they can use to argue your injuries weren't caused by the accident. They'll use your own words from that initial recorded call to poke holes in your story. This is psychological warfare designed to wear you down until you're so frustrated that you accept a lowball offer just to make them go away. So how do you fight back? You fight with documentation. You build a fortress of evidence they cannot breach. You get multiple repair estimates from shops you trust. You keep a detailed log of every single expense related to the accident. Medical bills, prescription receipts, transportation costs to doctor's appointments, and especially lost wages. Get a letter from your employer detailing the hours you missed and the income you lost. This is not negotiable. It's simple math and they owe it to you. For your injuries, you create a pain journal. Every day you write down your pain level, the activities you can no longer do, the impact on your family life, the emotional toll. This isn't just about feelings. It's about documenting your pain and suffering, a real, compensable part of your claim. It turns a vague complaint into a detailed, consistent record of your diminished quality of life. When you present your counteroffer, you don't just pull a number out of thin air. You present a demand letter, supported by your fortress of documentation. You send them a comprehensive package with every bill, every receipt, every estimate, every page of your pain journal. You show them with overwhelming evidence exactly what you are owed. You're no longer just a victim asking for help. You are an organized, informed claimant demanding what your policy promises. But what if they still won't budge? What if they delay, ignore your calls, or make an offer that is frankly insulting? There are times when documentation isn't enough. If you have suffered a serious injury, if the other driver was uninsured, if fault is being disputed, or if the insurance company is simply refusing to act in good faith, it is time to level the playing field. It is time to consult with a personal injury attorney. Hiring a lawyer isn't an act of aggression. It's an act of self-preservation. Suddenly, the adjuster isn't dealing with a stressed-out, inexperienced individual. They're dealing with a professional who knows their tactics, understands state law inside and out, and has the resources to take the case to court if necessary. The entire dynamic shifts. Often, the simple act of retaining a lawyer is enough to turn a ridiculously low offer into a fair one. Through this entire series, we've journeyed from the most basic concepts of liability to the complex nuances of stacking uninsured motorist coverage. We've dissected your declaration page, demystified medical payments, and pulled back the curtain on the industry's profit motives. And now we've walked through the fire of the claims process itself. The single most important takeaway from all of this is that your car insurance policy is not a product you buy and forget. It is one of the most important financial instruments you will ever own. It is your shield. It is your financial armor in a world of concrete, steel, and distracted drivers. But that armor is only as strong as your understanding of it. You are no longer just a driver. You are an informed consumer. You have the knowledge now to not just buy insurance, but to build a policy that truly protects you and your family. You have the tools to stand your ground when an adjuster tries to undervalue your loss. You have the power to turn a contract of complex legal jargon into a promise that is kept. So I'm asking you to do one thing tonight. Don't just click off this video. Go find your insurance policy. Open it up, look at your declaration page and read it with new eyes. Ask yourself, are these limits high enough? Do I have the right optional coverages? Is this the armor I want protecting me when things go wrong? If this series has helped you, if it has given you even a single piece of information that could save you from financial disaster, then share it with the people you care about. Your friends, your family, your kids who are just starting to drive. Because this isn't just about cars. It's about taking control. It's about understanding the systems that govern our lives and refusing to be a passive participant. It's about securing your financial future, one policy, one claim, one informed decision at a time. Protect yourself. Stay safe. And never stop fighting for what you are rightfully owed.